Today we'll be discussing short vertical spreads and how to trade them within Tastytrade. We're going to start by learning what they are, how they work, and also how to manage them throughout the life of the trade. And also, if you haven't opened an account yet with Tastytrade, consider using my link down below. But like I mentioned at the beginning, we are going to be learning about short vertical spreads, which is the simultaneous buying and selling of options at different strike prices, but on the exact same expiration. Now, rather than trying to use options to bet on a direction, the short vertical spread is going to be used to profit from time decay or from volatility decreasing. Now, if you're new to selling options, that probably sounds a bit complicated, but I promise you it'll make a lot more sense in just a few minutes. But for now, we're going to need to pull up an option chain to move forward. If you're looking inside a Tastytrade, we can find that by opening up the trade page over here on the left, and then just by double checking we have the table selected right up here at the top. From here, we can actually find the option chain right down here below, and on the left-hand side are all the option expiration dates available, starting here at September 15th of 2023 and going all the way out to January 16th of 2026. If you then take a look to the right of each of those dates, right here in the center of the screen, we can see the number of days until expiration. So right here, it looks like January 16th, it looks like is 858 days from today. Now finally, on that same little line here, we can also see on the far right-hand side, the expiration's current implied volatility, as well as the implied move in parentheses right here. Now coming back above, if we were to actually click on one of those expiration dates, like in this case, October 20th, you can then see an expanded list of a few available strikes right down the middle here, starting here at $9 and going all the way out to $22. If we wanted to expand that list out further and see even further out of the money strikes, we could come up here to the strikes menu up here in the upper right-hand corner where it currently says 14. And right there, we could either type in the exact number of strikes we wanted to see or just click on this little drop-down menu and select in the list below. Now in my case, I'm going to expand it to 20 strikes. And now looking back down in the option chain, if I scroll down a little bit, we can now see quite a few more strikes have been added. Right here, we can now see it begins at $6, goes all the way out to $25. If you were to then take a look to the left of those strikes, you're going to find all of the call options over here on the left. And then over here on the right, we can see all of the available put options. Looking up here at the top, we can also see what information is being displayed right down here below. So currently in this column, we're seeing the options current delta, the volume traded so far today, and the options current bid and asking price. Obviously, there's a lot more to this option chain than just that, but I think that's a good basic overview of what it is we're even looking at here. Now, when the time comes to actually place the trades themselves, you're going to be clicking on the options asking price when you want to buy and the bid price when you want to sell. Now, in our case, since we're going to be doing a short vertical spread, we're going to need to begin by selling an option. Whether we choose to sell a call or put is going to depend on whether or not we're more bearish or bullish on the underlying stock. Now, I know at the beginning I did mention that this is going to be a far more neutral trade, that you're not really betting on direction. You're more trying to make money from time decay, but it is still slightly directional. It's more neutral than a lot of other option strategies, but you do still have a bias in one way or the other. If we wanted to run through a real-life example, let's say that we were slightly bullish on Google. So in this case, let's go ahead and begin by coming up here to the search box at the top and flipping this over to Google, or G-O-O-G. I can then come down below and open up the option chain once again. This is kind of the first step. What option expiration do you want to choose? And for me, just for example's sake, I'm going to pick October 20th, which is 39 days from today. We're going to talk about expiration dates a little bit more in depth later on, but for right now, again, we just said that we were slightly bullish on Google, and just for example's sake, I'm going to come over here and pick the strike price that I think Google is going to remain above. I'm just going to say I think Google is going to stay above 125 up until expiration. Since that's the case, I'm going to look over here at the option's current bid and asking price, and it looks like right now the option is trading for 79 cents by 80 cents. And since I want to start by selling this option, I'm going to come over here to the option's current bid price, 79 cents, and just go ahead and click on that number. That is going to automatically build out an order ticket down here below to just outright sell that 125 put. Here it says that I'm selling one contract of the October 20th, 125 puts, And it looks like over here on the right, I'll be collecting a premium of 79 cents. Now, if this was all we were doing, this would be a cash secured put or a naked put. And I'd essentially be saying that I'm willing to buy 100 shares of Google at 125. So if Google does stay above 125, I get to keep this premium right here of 80 cents, and I never have to buy the stock. But if Google does drop down below 125 at expiration, I'm going to be forced to buy the stock at 125, but I'm also going to get to keep the premium I was paid. So I generally like to think of this like selling insurance on the stock. So as the option seller, we're taking on that role as the insurance salesman. If we go ahead and assume that the buyer of this put actually has 100 shares of the stock and wants to protect themselves against the stock going down, we're essentially telling them that no matter what happens, no matter how low the stock goes, I'm willing to step in and buy it at 125. Now that also means that the max risk on this trade is actually being assigned the stock and then the stock going to zero. So unless you have full options approval, this put is going to need to be secured with cash, meaning if we sell the 125 put, I'm going to need $12,500 in my account to do this. So if we actually did this, it is going to tie up a huge chunk of my capital, and it's a lot of risk that maybe I'm not willing to take on. So one way for us to reduce some of that risk is actually by purchasing a further out of the money put, protecting us against the event that we're wrong and the stock actually has a huge move down. So with that in mind, I want to buy insurance on this put that I just sold. So coming back up here to the option chain, let's say I was looking at buying a put $5 further out of the money. In this example, I'll be looking at buying the 120 put, and coming over here to the right, I can see it's currently trading for 41 cents by 42 cents. So again, by buying this put, I'm buying insurance, but I'm paying money for that. I'm giving up some of my potential reward, some of my 80 cents that I'm receiving, in order to protect myself to the downside. So now to do this, because I do want to buy that put, I want to buy the 120 put, I'm going to be clicking on the asking price of 42 cents. Now that I've selected that long put, if we were to look down below in my order ticket down here, you can now see I've got two orders down here. It looks like I'm going to be selling one of the 125 puts while simultaneously buying one of the 120 puts. And now if we come over here to the credit on the right, you can see I've given up a good chunk of it. I've probably given up about half of it in order to protect myself. So now it looks like I'm only going to be receiving 39 cents for selling it. But I don't have to accept that. I could always try and get more. I could bump this up and say, hey, I'm only willing to do this if I can get $1 credit. Or hey, I'm only willing to do it if I could get $1.50. Obviously, just remember that the only way that's going to happen is if the spread actually increases in value. And for that to happen, Google is pretty much just going to have to drop in price, which is going to increase the value of this spread. We could also adjust the rest of the parameters in here. We could change the number of contracts I wanted to sell. So right here where it says -1 and 1, if I were to bump that up to, let's say 5 contracts, you can see that down below it also adjusts it to 5. You also have a lot of really helpful information right up here above about this order. So right here it says my probability of profit. That means the probability of me making at least 1 penny on this trade is 90%. We could see I'm going to be collecting $750 because that's how much extrinsic value is in these contracts if I were to actually sell them for $1.50. We can see the probability of getting a 50% profit on this trade is 93%. The overall delta for the trade is positive, so I am slightly bullish on the trade. I've got nearly 30 delta. Looking here at my theta, it's telling me I'm making about $4.64 a day due to time decay. It says my max profit potential is $750, and my max loss is $1,750. Now, just so you guys can understand how those values are calculated, let's come down here and adjust this back down to just 1 contract for now. And to make the math really simple, I'm going to come over here and assume we get $1 for selling this vertical credit spread. All right, so now that we've made those changes, if I were to assume that things go completely against me, the most I can lose on this vertical spread is going to be the width of the spread, so in this case $5, minus the credit that we received. So in this example, the most I could lose is going to be $4 or $400. And the way that I calculated that is by first finding the width of the spread, which remember, in this case, the width is going to be $5 wide, the difference between 125 and 120. And then what I'm going to do is subtract the premium that I received. which in this case is going to be $1. So the most I can lose is $5 minus $1, which is going to be $400. On the flip side, the max profit I can make is going to be the credit that we received. So in this case, the most I can ever make on this trade is going to be $1 or $100. Like I said, you don't have to do this math yourself. It does show you right up here in the upper right-hand corner, max profit of $100, max loss is $400, and some other useful information like probability of profit, your delta, your theta, just useful things that you might want to keep an eye on. Now, diving back into this spread, remember I said that the most you could ever make on this vertical is going to be $1, and that is true, but the only way that you can ever make that full amount is if we actually held the spread through expiration. So if you never closed it, and Google actually closed above 125 and you just let these options expire, you would collect that full $100 of profit. But very rarely, or if ever, are you going to hold a spread all the way until expiration. And I will talk about that a little bit later. But for now, in order to submit this trade, we're going to come down here below and hit review and send. We're going to double check that everything looks right in here. It does tell us we're about to sell one Google vertical put spread. I'm saying I only want to do it if I can collect a credit of $100. And now in order to place it, we'll just come down below and hit send order. Once placed, if we wanted to keep track of that, we could come back up here above to the positions tab. And now just to the right, we can see I've got a working order to sell this 125 by 120 put spread if it ever trades for $1. But obviously with the spread only trading for 38 cents at the moment, that's probably not going to happen. And if I ever wanted to cancel this order or edit it in some way, all I would have to do is right-click on the order ticket here. And then within this pop-up menu, we either hit cancel order to outright cancel it or hit replace order to edit it in some way. In this case, I just want to cancel it, so I'm going to come up here and hit cancel order. And now we can see it's been removed, so I'm no longer trying to sell that vertical on Google. Now, in the event that you're ever neutral to bearish on the underlying stock, again, you don't really think it's going to move much, but it's probably more likely to go down than it is to go up, we could look at selling a call spread instead. So in my example, let's say I thought Alibaba was more likely to fall in the near future than it was to go up. So what I'm going to do is come up here, and instead of having Google up here, we'll throw in Baba. We'll then come down here below to the trade page where we can now find the option chain for Alibaba. I'm going to start by finding the expiration date that I wanted to trade, in this case, October 20th. We'll just go ahead and stick with that one. I can then take a look at the strikes right down here below in the center of my screen. And let's just say that I thought Baba was going to remain below $95 a share. So what I'm going to start by doing is coming over here to the call option and seeing what it's currently trading for. Looks like $1.93 by $1.98. And since I want to sell that call option, I'm going to come over here to the current bid price of $1.93 and just start by clicking on that. I can then see down here below, it builds out an order ticket to just sell that call. And in this case, that would be a naked call. And with a naked call, I have unlimited risk to the upside. I could theoretically lose an unlimited amount of money. So what I want to do is hedge this trade by going about $5 further out of the money and finding the 100 strike call. And now in order to buy that one as my protection in the event that the stock goes up and I was wrong, I'm going to go ahead and click on the current asking price of $1.02. In the order ticket down below, you can now see I'm selling one of the 95 strike calls and I'm buying one of the 100 strike calls, and it looks like I'll be doing that for a total credit of 95 cents. In this example, let's just say I'm okay with that. 95 cents, not too bad. I want to place this, so I'm going to come over here and hit review and send then hit send order to actually place it. You probably heard that really loud ding, so it is telling me that the order filled, and if I wanted to keep track of it, I could come back up here to my positions page, and right now I can't see that new position I just created. And if I look up here, it's because I don't have options selected, so let me go ahead and click on that. And now down below I can see Baba, and by clicking on it, we can now see that vertical spread that I sold. If we look to the right, we can see my overall trade price for this vertical was 95 cents, and at the moment, I'm down $1 since selling it. But just keep in mind that this is a slow-moving strategy, one that takes time to play out. So as time passes, time decay is going to start working its way out of these contracts. And as long as Alibaba stays below $95, the call that I sold, we're going to start slowly beginning to generate income. Now, when the time eventually comes to close out this vertical, what we're going to do is come over here to the left and start by right-clicking on the position. But in this case, since I have two options here, I need to select both of them and then right-click on it. I can then find in this little window to the right a lot of different buttons, but for right now, we're just going to click on the one that says Close Position. We can then see that that automatically builds out an order ticket to buy back the 95 and sell to close the 100. So this is going to be automatically closing out the vertical that I sold. If we then look over here to the right, we can then specify the price that we want to buy it back for. And obviously, I want to buy it back for lower than what I sold it for originally. Since barely any time has passed, it's basically exactly what I sold it for. It's pretty much the same price. But what I could do is set it to buy it back if the spread ever hit, let's say, roughly 50% profit. So what I'm going to do is come over here to the credit, and for now, I'm just going to type in 50 cents. And since that is probably not going to happen today, I'm going to come over here to the time in force where it's currently marked day and go ahead and flip that over to a GTC order. So now with that set, this order is going to go out every single day to close it out if I ever hit that 50% profit target. To send that, we'll again come down here below and hit review and then send order. Just like before, if we head back up here to the positions page, you can now see my position right up here on the top, and then my working order down here below to close it out if it ever hits 50 cents. But I know that was a lot, but we really did cover all the basics, everything you should need to know to get started selling credit spreads within Tastytrade. Hopefully you now feel at least a little bit more comfortable with the process, and I know there's a lot I only covered briefly, so if you are looking to learn more, consider checking out this video next. You might find it helpful as well. Otherwise, have a great rest of your week, everyone, and I hope to see you on the next video.